Good evening. Good evening. I'm delighted, first of all, to be here. I really want to thank my hosts. I have been hearing about this extraordinary foundation from my colleague Mercedes, and I come here and I realize they haven't even given it half the credit it deserves. This is a truly remarkable institution, and I'm honored to be part of the presentation tonight. And I also am glad for the introduction of Mercedes. You will see us speaking later, but she has been such an important colleague in work that we are doing on another part of the economy. But tonight, I want to have a conversation with you about an area that I think will transform the way we think about small business and financial institutions. And as you know, I've written a book on this, but the two themes that I want you to think about today. The first is artificial intelligence. Many people think that the first time we are going to really be affected by artificial intelligence will be driverless cars. But that's very far in the future. The impact of artificial intelligence on banking, particularly small business banking, is going to happen soon, within the next 18 months to 2 years. It's going to be visible in small businesses and to consumers. The other thing I want you to think about is the importance of small business to the economy and what impact the transformation that artificial intelligence will bring will have on the small businesses that you know and the small businesses that affect the Spanish economy. I'm going to use my experience to tell this story. And the reason that I wrote this book dates back to a time 10 years ago, actually exactly 10 years ago, from the day the book was published. I had the great honor of taking a job working for President Barack Obama. And the job was to be responsible for all of America's small businesses. Now, this was a terrific job. I got to fly on Air Force One, and I got to be a member of the President's cabinet. This is a picture of the Roosevelt Room in the West Wing in the White House. And I don't know exactly what I'm saying to the president, but he does not look very happy with me. So there were good days and, of course, not as good days in the White House. But one of the things that was difficult about this job was the timing. I took this job when it was the first quarter of 2009. January 2009, think back, was the beginning of the recession, of the financial crisis. And I show you for a minute what was going on. This is a graph of the jobs in the United States. The red line is small business jobs. And as you can see, there was tremendous loss of small business jobs. Now, the blue line is large businesses. They were much less affected. Why? Because we know that in a financial crisis, in a credit crisis, those entities that are credit dependent suffer the most. And small businesses depend on their banks. They can't go to big financial capital markets to get capital. And in this crisis, banks across the world were suffering. They had gotten overextended in mortgages, and they didn't have room on their balance sheet for small businesses loans. So in the White House, I had to find a way to do something bold. And in the United States, we have the Small Business Administration. We guarantee government loans. I did something as a venture capitalist coming to the White House that, in retrospect, if I had been a politician, maybe I wouldn't have done. But I raised our guarantee of small business loans by the government to 90%. and we got an immediate impact. 1,000 banks came back to lending to small businesses in 6 months. Now that made a big impression on me because it showed me how dependent small businesses are on credit and what impact you can have if you make credit available. So now we fast forward to today and we say, why is this important? Why is this important in the US and also in Spain? Because half the people in the United States and 70% of the people in Spain are employed by small businesses. That's most of the jobs. But I think that small business does not get its fair share of attention from government and economists. Why? Because government and economists think about first consumers. How are the consumers doing? Then they think about investment. Well, investment is mostly big business, government spending, and the macroeconomic models tend to ignore small business. So it is left to some of us to pound the table and say, no, remember this number. It is 70% of the jobs in Spain and 90% of the GDP. The other thing to remember about small businesses is that we are not talking about Silicon Valley small businesses. We are talking about the businesses that are part of your daily life. So this is the data on US small businesses. I looked at the data for Spain. It's very similar. In the US, there's 30 million small businesses. 24 million have no employees, one person. And that segment is growing because of the gig economy. Most of the rest of the businesses are also small businesses. We call them Main Street, cafes, dry cleaners, but they're all different. And then there's a very important segment that Mercedes and I will talk about, which is very prevalent in Spain, supplier businesses. They supply other businesses. And this is a segment we have to pay special attention to, particularly because they need capital to run their businesses, to buy inventory. We are not talking about this very small number of high-growth venture capital-backed businesses. Today, they're important. I don't want to ignore them. But today, they don't really borrow from the banks. They're really from getting their capital from venture capitalists like me. And they are not part of the small business lending story. They're also a very small number. Even though that they are going to grow and be the next Google, they're a very small number of the total number of small businesses. Okay, so what's the problem? Why do we even have a problem? Why am I here? Because banking has not changed in 50 or 100 years until recently. In the traditional small business loan, you would Xerox a pile of paperwork. Remember Xerox? You'd carry all the paper over to the banker. The banker would look at your tax returns and your accounting statements and say, I need a personal guarantee. Why? Because the banker could not see into the business, and it would take 3 months or 3 years. We call this first problem information opacity. You can't see inside a small business. You don't know if that small business is making money. Well, it turns out that technology has the power to take away information opacity. With big data, we can make you be able to see inside a small business. The second barrier and friction plaguing small business lending, making it difficult for these poor bankers, is heterogeneity. I just showed you a slide of all these different kinds of small businesses. Imagine you're a banker. One day you're lending to a coffee shop. The next day you're lending to a dry cleaner. The next day you're lending to a parts manufacturer. It's all different. But imagine that you had data on 1,000 dry cleaners. When you saw the 1,001st dry cleaner, you would know this is a good dry cleaner or a bad dry cleaner. So once again, we're at a moment where big data and artificial intelligence and machine learning have the power to take away some of these barriers and frictions. So we are at the early stage of a transformation. At Harvard Business School, we talk a lot about innovation, and we have these innovation S-curves. Innovation in technology starts off very slowly. There are people who don't really believe, and you have to do something we call crossing the chasm, and all of a sudden things take off. And then eventually, you reach maturity, and some other disruptor will come around and disrupt you. So where are we in the innovation curve? Early stage. There's a little history to this movement, even though it's very new. The first fintechs came out in 2010, and by 2014, you thought that fintech was going to take over the world and banks were going to be dead. They were dinosaurs. They couldn't change. And the image was David was going to kill the giant, Goliath. Well, it turned out that was too simple a view, because it turned out that the incumbents, the big banks, had a number of assets that were being overlooked. So this is a graph that puts the big banks, the incumbents, JP Morgan Chase, Wells Fargo in the United States, and many community banks, against the new disruptors. Banks had two major assets that have proven very important. First, they have customers. The fintechs were spending a lot of time trying to find a customer who would trust them with a loan. The second is money. Banks had low-cost deposits, your money, that they were lending out, costing them pretty much nothing at the time. Fintechs were borrowing their money from hedge funds at about 10% money. So their loans turned out to be very expensive. So what happened? Takeoff aborted. It turned out that the early adopters, the early fintechs, did not have long-term success. But suddenly, the world was transformed in terms of its thinking, and big tech entered. Amazon, PayPal, Square have now become small business lenders, and the dinosaurs woke up. JP Morgan Chase spent $9 billion last year on technology, and Santander Bank yesterday bought a fintech in Mexico, and many banks, large banks and small banks, have decided they would not give up their markets to the upstarts. So now this is what we have. And I'm going to try something with you that I try with my classes. Okay. The question is, we have a new fintech landscape, and who is going to win and who's going to lose? So there's big banks and credit card companies, option one. Big tech. In China, Ant Financial owns this market, option two. Fintechs, the new challenger banks, option three. And then I've added a fourth option. There's new technology companies providing the infrastructure and all of the parts for the new world of fintech. So let me just try you. How many of you think that the banks are going to survive and that they're going to win in this environment? Raise your hands, because I want to see. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 22. I'm very good at this. Big tech. Ooh. 47. Fintech. 5. Infrastructure players. Ooh, 17. 15, 14, something like this. Okay, so this is not dissimilar, by the way, to this afternoon's lunch and several of the classes that I've had at Harvard Business School. But the truth is, we don't know yet. We don't know. This is an ongoing story. So let me come back. I'll come back to some other predictions in a minute. But let me tell you why I think this transformation is happening right now at this minute. And the answer is something called APIs, Application Programming Interfaces. So APIs are data pipes, and they can suck the data from your bank account under open banking. They can take your credit card information and put it all into a black box where algorithms can create intelligence that allow a transformative view inside your business. Take away all that information opacity. And a lender now can see a dashboard or immediately say, oh, this is a creditworthy borrower. This one is not. But the interesting thing to me is that that same dashboard has one other use. Imagine if you're a small business owner and you have a dashboard of your potential cash flows. I call this in the book Small Business Utopia. So here's how it works. I was telling this story to a small business in my hometown, which is Brunswick, Maine. Maine is that state at the very tippy top of the eastern side. It's very cold. And in Main Street in Maine, this young woman has a craft brewery. She makes her own beer. And she said, I go home at night and I open one screen with my bank account, another screen with my Square account, another screen with my credit card, and in my head, I am trying to create the cash flow, the Excel spreadsheet that tells me, do I have enough money to buy a piece of new equipment? Do I have enough money to pay my employees? Well, that dashboard is the same information that the lender is going to take up to assess whether you're creditworthy. If that is available to the small business owner, imagine it has a button right in the middle, and it says, press here, you are pre-approved for 10,000 euros of a loan. And we know you're going to need it in 2 weeks because we've seen your projections, and we know that you can pay it back in 6 months because the Christmas season will happen and you'll have more money. That could be transformative for small businesses who today, if there's a late payment from a customer, they're in a cash crisis that can be life-threatening. So that would be the good side. Let me spend a few minutes on the dark side of the black box. What happens if we have this world that I've imagined? And we have all these algorithms. Who gets to look inside the black box? What if your credit history has a mistake in it? It has an error. Do you get to go correct it? Can you even see what the error is? Today in the United States, if your credit score has an error, you can correct it. What happens if the error is in the algorithm? If you're the regulator, maybe we have some regulators in the room, do you get to look? How do you develop the expertise to look inside an algorithm? What if the machine is learning from data that has bias in the data? What if the machine has data that says, you know, everybody on this side of the room shouldn't get a loan. They won't pay it back. Well, the machine is going to learn never to lend to anybody who's on this side of the room. We know our data has, our history has bias in it. I know from running the Small Business Administration that women-owned businesses, minority-owned businesses got fewer loans, even if they were creditworthy. That data, that bias, will be built into our algorithms. Finally, we have a question that you in Europe have answered. Who owns the data? You have decided in Europe, with the PSD2 and open banking, that the customer owns their data. And that has proven to be, I think, prescient ahead of the thinking in the United States, where we're confused. If you ask, which I did, our Treasury officials, who owns the data, they say, it's murky. Murky means you can't see. We don't know. I said, that's a bad answer. Because who owns the data and who can permission the data will be one of the fundamental questions that determines how this story unfolds. You need to be able to give permission for your data in order to have all of those infrastructure companies helping create new fintechs that will help your bank give you better service, give you new applications. This is what the US regulatory system looks like. I call this spaghetti soup. I know there is no soup made of spaghetti, but it's a mess. We have 7 regulators who regulate banking, and they disagree. And we have 50 states who each have their own banking commissioner, so we actually have 57 banking regulators, and they're fighting. So I'm very concerned and spending a lot of time in Washington with our regulators. But you have an advantage in Europe, and I submit perhaps even an advantage in Spain, where you have the ability perhaps to go ahead since you have resolved this key regulatory issue. So let me tell you just briefly who I think will be the winners and losers. And we can continue the conversation when Mercedes comes up. But I think that you have to ask 3 questions in order to look into the future. Now remember, I said this is undecided, so these are just my predictions. I think that the first question is, who has the customers? And there, the people with the advantage really are the large banks, the small banks who have a very trusted relationship with their customer, the credit card companies, and big tech. Who provides the capital? There, I think the banks have an advantage. They have the low cost of capital. Although you could argue that Apple and Amazon have a lot of money, and you know Apple just did a credit card. And the last question is, who has the best technology? And there's many kinds of technology, but the 3 that are important is who builds the best data infrastructure, who understands algorithms and artificial intelligence so they can be smart about picking creditworthy borrowers, and who gives the best customer experience. And there, of course, I think big tech has a big advantage. So what will happen? Number 1, remember I said this is coming fast, a lot faster than a lot of other applications, and we need to be ready. Number 2, I think banks and big tech have lower costs, and they are going to realize small business is an important market. Banks today have focused on consumer applications, but margins are going to shrink in banks for mortgages. Already, mortgages are like a commodity. We have automatic rocket mortgage in the United States. It's taking all the money away from the banks, so they are going to turn to small business where there still will be margin. And I believe that the small banks now will be able to go back to having a relationship with a customer. Finally, I think, as we talk, financial regulation is going to determine a lot about how these markets develop and who wins and who loses. And today, the regulators, particularly in the US, are not equipped to deal with data monopolies that Amazon or Facebook might have. much less the ownership of the banking data in the US. So we have some big questions ahead of us. But if we do this right, and this is why I urge us to think carefully, and why I wrote the book and am out talking about the book, because the stakes are very high. Who really wins if we get this right? Well, I say I don't have a dog in the fight between big tech and banks, but I do have a dog. My dog is the small business. That's who I think will really benefit, because we'll get more credit-worthy borrowers with less disparity. We're going to get a better customer experience, and more small businesses will succeed because they will be able to withstand these unexpected cash crises. For the book, I went back and asked a simple question. When is the first small business loan ever recorded in history? And the answer is Mesopotamia, 3,000 years ago. So there is a stone tablet where it's recorded that a baker got a loan from somebody who was acting as the banker, and he got the loan because he was the baker to the royal household. And his loan was recorded, the amount was about 6% interest. Now, on this same tablet, there were a number of other loans to fishermen that were recorded, and they were paying about 20% per month. So we know from the dawn of history, small businesses needed access to capital to run their businesses, and we know that there was a great disparity in the small businesses and the pricing of the loans that they were getting. But if we look at the future, we may have a transformative moment. We may have a change. We may have an opportunity to get small businesses the capital that they need to grow and survive. And if we do that, particularly in a country like Spain, we can transform this critical segment of the economy and perhaps create more access and opportunity for people like my family who came to America with nothing and were able to grow and prosper by building small businesses. And that is the notion of the American dream that I think also can be transferable to a country like Spain, who has a long history of entrepreneurs and opportunity, and perhaps in the future can use technology to even advance those businesses and the economy as a whole. Thank you for having me.